So this is the second part of our second reading on financial statement analysis. The reading's name is Financial Reporting Standards. Okay, so we have already had an introduction to this reading. So this section 2 is about the objectives of financial reporting. The learning outcome is that we should be able to describe the objective of financial reporting and the importance of financial reporting standards in security analysis and valuations. So financial reports, as we are very well familiar, we have this statement of financial statement, otherwise called balance sheet. It has all your assets, liabilities and equity. And then we have the statement of comprehensive income, which has your net income and other comprehensive income. And then we have your statement of cash flows. Well, then there are other supplemental disclosure that are there, notes to the accounts, management discussion and analysis. Then you have an auditor certificate certifying the worthiness of that financial statement. So when we are talking about the objectives that these standard setters have on their mind, for example, when they are deciding about setting certain sort of standards to guide these people preparing financial statements, for example, they can always set a standard about how detailed the notes to the accounts should be. For example, let's say you have a multinational company, let's say Caterpillar. We all are familiar. Caterpillar is a US conglomerate that that deals with earth moving equipment that is used in infrastructure development. Then it also has a financial arm that leases all this equipment. And then they also prepare apparel, shoes, and a range of consumer items as well. Now this company literally operates in all of the countries across the globe. So there could be a standard which dictates or which asks that the company to give a detailed account of how much sales is originating in what sort of markets. That's very reasonable for a multinational company to be reporting, so that the investors and the analysts are able to understand what sort of global events can have an impact on the sales of this company. Similarly, since this company is operating in producing a wide range of goods, from infrastructure goods that are used in automobiles that are used in infrastructure projects, to consumer goods such as apparel, footwear, etc. So there could be a standard asking the company to give a segment-wise account of its sales and costs. This way the users of the financial statement would be able to understand what sort of industries or what changes to all these segments of economy can have, what sort of impact would these changes have on the sales of this company. So talking about what's the objective for setting these reporting standards. The objective for setting these reporting standards is that these statements should provide financial information that is useful. This is a key word over here, useful to the users in making decisions about providing resources to the reporting entity. For example, if you are invested in stocks, it should be useful enough, or at least provide enough information for you to make up your mind to analyze the underlying company, and whether you should be investing in this company's equity or not. Similarly, people who are lending to it, other forms of credit, for example, suppliers credit, bank loans, or people who are interested in buying debt from this company. And it should also be useful in providing information that people can use, then potential investors can use to influence the management's actions that affect the eventual outcome of this company. So moving on, previously, before the advent of globalization, when all the economies operated on their own, and there was very little movement of capital across national borders, the local standard setting bodies in each of their respective jurisdictions would come up with their own standards for financial reporting. Sometimes these were rule based. When we say rule based standards for financial reporting, we mean that it is something quite comprehensive. For each step or wherever you have to make a decision about how to report a certain number on the financial statement, there would be one guideline available. For example, sometimes, just like we follow instructions on many products that we use. For example, when you're using a calculator or a cell phone, you have to turn it on by pressing a certain button. Then you need to input certain inputs in a particular way. So the rule based standards are quite comprehensive and complex. They tell you 1, 2, 3, 4, 5, 6, 7, 8, and this is how you arrive at a decision. In contrast, we have other rule standard setting bodies that adopted a more generic, a more principle based rule or guidance on how to apply these accounting standards or financial reporting standards. They are more generic in nature. So eventually, with investors becoming more global in nature, so maybe an investor in, let's say, USA is more he's more used to financial statements based on US GAAP. Now this investor aims to take advantage of many opportunities available in, let's say, China. Now the Chinese financial reporting standard setting bodies must have adopted a different set of standards when compared to US GAAP. So this could result in a lot of confusion. So as time went by, we have seen conversion towards uniformity. When we talk about uniformity across various jurisdictions, we definitely need more generic standards. So this convergence towards uniformity has led to financial reporting standard setting bodies coming up with standards that are more based more on principles rather than rules. So moving on, the development of these standards is a very complicated process. For example, IFRS has a number of members. These members are the standard setting bodies in their respective countries. Each standard setting body reflects on their culture within their country, and thus they come up with these standards, and then IASB converges all these standards. And one very interesting thing is how to apply judgment. Companies reporting their earnings in financial statements, at times they have to make estimates. Sometimes they have to apply the judgment. So having some consistency in applying this judgment is what IFRS or International Accounting Standard Setting Body is, aiming for. Both IASB and FASB have developed similar financial reporting frameworks, so that there is a lot of uniformity across the globe. Since these financial reports are providing information to a varied number of users, so they cannot be specific only to people who are investing in equity or debt. So we need to look at these statements from that they have been developed from a generic perspective. So this leads us to the end of the second section. In the third section, we are going to talk about the role of these bodies and regulators. That's about it from this section.